I usually come into these deep dives buzzing with energy. We've covered everything from AI to ancient history, but, well, when I saw the documents for today, I'm not gonna lie, I hesitated.
Oh, why's that?
It's a legal contract. Specifically, it's Clause 19 of the FIDC Yellow Book, the 2017 edition. The title is just insurance. It sounds like the absolute driest topic we could possibly choose.
I get that. On the surface, it does look like pill bureaucracy, just checking
It's
boxes.
Exactly. I was ready to fall asleep, but then I actually started reading it, and I realized this isn't paperwork. This is a disaster movie script.
That is certainly one way to look at it. A dramatic one.
No, I'm serious. Think about it. You're building a billion-dollar factory. Clauses 1 through 18 are all about how to build it right. But Clause 19, it's all about what happens when everything goes catastrophically wrong.
You mean fires, collapses, lawsuits?
All of it. This is the, in case of emergency, break glass chapter of construction.
And you're absolutely right about the stakes, especially in the FIDIC Yellow Book, which, is for plant and design build projects. This clause is the only thing standing between a bad day and total financial ruin.
Right. So our mission today is to decode that survival guide. We have the employer, that's the client, and the contractor, the one designing and building. When disaster strikes, who writes the check?
And the answer is surprisingly complex. It is not as simple as the insurance company pays. It's a whole web of liability, deductibles, and some very aggressive rules.
I saw that. There's a 115% rule in there and something called a step-in power that felt almost predatory. But let's start at the beginning. Clause 19.1, the general rules. Who has to go out and get this insurance in the first place?
Well, the burden is firmly on the contractor. The text is very clear. It says the contractor shall effect and maintain all the required insurances.
So they have to do all the legwork, find the broker, pay the bills.
All of it.
Okay, but can they just buy the cheapest policy they can find, from some bargain bin provider?
Definitely not. The contract is very specific. The terms have to be subject to consent by the employer. Basically, the client has to sign off and say, yes, this is good enough to protect my project.
So the employer sets the minimum standard.
They set the floor. And usually the specific financial limits are already locked into the contract data before a single shovel hits the ground.
I did notice an interesting little phrase in there, though. It said the contract requirements are the minimum.
That is a vital distinction. So say you're the contractor and you get to the site and you realize, wow, this area floods a lot, or theft seems really high around here.
The maps didn't tell the whole story.
Exactly. Clause 19.1 explicitly allows you, and I'd say encourages you, to add more insurance if you deem it prudent.
Prudent. I love that word. It feels like lawyers speak for don't come crying to us if you underinsured yourself.
That's precisely what it is. You can buy extra coverage, but, and here's the kicker, you do it at your own cost. The client isn't paying for your extra caution.
Right. Okay, now let's talk about the proof. Because it's not enough to just say you have insurance. You have to prove it constantly.
It is a very tight leash. Every single time a premium is paid, the contractor has to send proof of payment, a receipt, a confirmation to the employer.
It feels like a parent checking a teenager's homework. Did you pay the bill? Show me. What's so strict?
Because if that policy lapses for even a single day, the entire project is exposed. Imagine a fire breaks out on the one Tuesday the policy was suspended for non-payment. It's a catastrophe.
Okay, that makes sense. So what if they don't pay? If the contractor just forgets or runs out of cash?
Then we trigger the step-in power. This is where Clause 19 gets its teeth.
Ah, yes. The fine, I'll do it myself clause.
Essentially, yeah. If the contractor fails to keep the insurance in force, the employer can step in, pay the premium themselves, and keep the policy alive.
And I'm guessing they don't just absorb that cost out of the kindness of their heart?
Not a chance. They pay it, and then they immediately recover that cost from the contractor, usually by just deducting it from the next payment.
So the contractor sends a bill for $1 million, and the employer sends back $900,000 and a note saying, I paid your insurance for you.
Exactly. And there's a key procedural detail here that the lawyers listening will appreciate. The text says, the provisions of Clause 20 shall not apply.
Okay, you have to translate that for me. What's Clause 20?
Clause 20 is the formal claims process. Normally, for the employer to take money, they have to file a notice, give particulars, wait for a review. It can take months. It's a whole thing.
A bureaucratic slog.
Right. But for this, Clause 19 strips all of that away. The deduction is immediate. There's no argument. It ensures the employer isn't left out of pocket.
Brutal, but efficient. Okay, let's move on to the big one, ensuring the works. Clause 19.2.1, this is the policy for the actual building, right?
This is your core property insurance, yes.
Yeah.
It covers the physical thing you're building. If it burns down, blows up, whatever, this is what pays to rebuild it.
And it has to be in joint names. Why is that so important?
It's all about preventing a legal mess called subrogation.
Whoa, okay, fancy word. Break that down for us.
Okay, imagine the contractor accidentally starts a fire. Welding sparks, roof goes up in flames. If only the contractor is insured, the insurance company pays them to fix it. But then the insurer might turn around and try to sue the employer to get their money back.
So they pay out with one hand and sue the client with the other.
They can try, but with joint names, both parties are the insured. You can't sue your own client. It forces the insurer to just pay the claim and move on.
That makes perfect sense. Okay, now the value. How much do we insure for? If the factory is $100 million, we insure it for that, right?
You would think so. But no, the FIDIC Yellow Book requires coverage for the full replacement value plus an additional percentage. The default is 115%.
115%. So on a $100 million job, we need $115 million in coverage. What's that extra $15 million for?
Well, it's for all the incidental costs.
That feels like a lot of incidentals.
Think about it. A storm destroys a half-built structure. You don't just start rebuilding. First, you have to pay for demolition. You have to haul away all the debris. Then you need engineers to come back out, resurvey, maybe even redesign parts of it.
Ah, I see. You have to pay to clean up the mess before you can even start fixing it.
Exactly. Demolition, debris removal, professional fees, that can easily eat up 15%. It's a crucial buffer.
Okay, this next part really confused me. The defect exclusion. It says insurance covers damage resulting from a defect, but not the cost of the defect itself.
This is a classic concept in construction insurance. You have to remember, insurance is for accidents, not a warranty for bad work.
Give me an example. Let's say I'm the contractor building a warehouse.
Okay. And let's say you miscalculate the strength needed for a main steel beam. You install it. It's a defective part.
Right. Then I finish the building, install a brand new generator right under that beam, and then snap. The beam breaks, the roof collapses, the generator is crushed.
Perfect disaster. So the insurer will pay for the new roof. They will pay for the crushed generator. That's the damage resulting from the failure.
Yes.
But they will not pay for the new steel beam.
The thing that started the whole mess.
Correct. You designed it wrong. That was your mistake. You have to pay to replace your own bad work. The insurance covers the consequences, not the mistake itself.
That is a razor-sharp distinction. So if my bad wall falls on a Ferrari, insurance buys the Ferrari, but I have to pay for the wall.
You got it. They protect you from bad luck, not bad engineering.
Got it. Okay, let's move on. We've covered the building itself. What about the stuff that goes in it? Clause 19.2.2 talks about goods.
This one is simpler. It's for the materials and plant, the bricks, the pipes, the turbines, from the moment they're delivered to the site until they're no longer needed.
So if $1 million of copper wire gets stolen from the site before it's even installed, this covers it.
That's exactly what it's for.
Okay, now let's pivot to what makes the Yellow Book special. It's design build. The contractor isn't just building, they're the designer.
Which introduces a huge new risk. What if the building doesn't fall down? What if it just doesn't work?
You mean like a power plant that doesn't generate power?
Exactly. That's not a physical accident. That's a breach of professional duty. And for that, you need a different kind of insurance. Clause 19.2.3 requires professional indemnity insurance, or PI.
This feels different.
It is very different. Property insurance is for physical damage. PI is for financial loss caused by your errors or omissions in the design.
I saw a phrase in here that honestly scared me. Fit for purpose. The text says the insurance might have to cover the works not being fit for purpose.
That is the absolute highest standard of liability. Usually, a designer just has to use reasonable skill and care, but fit for purpose doesn't care if you tried your best. It only cares if the thing works as promised.
So if you promise a factory that makes 10,000 widgets an hour and it only makes 5,000, you're liable.
You're liable. And getting insurance that actually covers that specific fit-for-purpose risk is incredibly difficult and expensive. Insurers hate it.
And the timeline is different here too, right? PI insurance has to be maintained long after the project is finished.
Yes, for a runoff period, often for years. Because a design flaw, maybe in the foundation, might not show up for 5 or 10 years.
And the policy has to be active when the crack appears, not when the mistake was made.
Exactly. It's claims-made insurance. So you need a policy in force in 2028 for a mistake you made in 2024. The contractor has to keep paying those premiums long after they've left the site.
Okay, part 4. We've covered the building, the design, now we have to worry about people, third-party liability.
This is for everything outside the project itself. Your crane knocks over the neighbor's fence, or a truck kicks up a rock and hits a pedestrian.
There was a technical term here I need you to explain, cross-liability.
Right. This goes back to the joint names issue. Remember, the employer and the contractor are both insured on the same policy.
They're in the same boat.
Exactly. But what if the contractor's bulldozer accidentally crashes into an existing office building that the employer also owns? That office building is third-party property.
But the owner is one of the insured parties.
And standard policies often have an insured versus insured exclusion. The cross-liability clause fixes that. It basically tells the insurer to pretend the employer and contractor are separate entities for that claim. So the employer can claim against the policy as if they were a stranger.
That is such a subtle but crucial detail.
It'd save millions in arguments, I'm sure.
And finally, the workers themselves. Clause 19.2.5.
Workers' compensation. This is standard stuff. The contractor must insure their own staff against injury or death on the job.
And the policy has to indemnify the employer.
Yes. That's to stop a worker from getting paid by the contractor's insurance and then also trying to sue the employer because it happened on their land. It shields the employer from those backdoor lawsuits.
Unless the employer was actually negligent, of course.
Of course. This is for standard site accidents. The contractor owns that risk.
So when you put it all together, Clause 19 is like a complete suit of armor. You have plates for the building, the design, the neighbors, the workers.
It is a comprehensive shield, and it has to be. Construction is just too risky otherwise. One bad spark could bankrupt the contractor and leave the employer with a pile of ash.
It really highlights the power dynamic, though, doesn't it? The contractor does all the work, pays all the bills, but the employer holds the leash, approves the terms, demands the receipts.
That's the golden rule. He who has the gold makes the rules. The employer is protecting their investment.
But here's a final thought I want to leave with everyone. We've said over and over that the contractor pays for this at their own cost. The text says it. But let's be real. When a contractor bids on a project, they've already calculated all those insurance premiums, right?
Oh, absolutely. It's a line item in their estimate. It's just part of the cost of doing business.
So they add that $2 million for insurance right into their bid price.
Oh!
Which means, in reality, the employer is paying for all of this. They're just paying for it indirectly. They're funding the very insurance policy that protects them from the contractor's mistakes.
That is the economic reality of it, yes.
It makes you wonder, if the employer is footing the bill anyway, why the elaborate dance? Why doesn't the employer just buy all the insurance themselves?
Some do. There are things called owner-controlled insurance programs, or OCIPs. It gives them more control. But that's a topic for a whole other deep dive.
Oh, don't tease me. That was Clause 19, decoded. From dry legal text to the financial survival guide of the construction world.
It was a pleasure to unpack it with you.
Thanks for listening to the deep dive. Check your policies, pay your premiums, and we'll see you next time.